On this episode of Full Signal, I sat down with Todd Sohn. Todd is one of the smartest people in finance that I've ever met. He works at Strategas in asset management and research. In this conversation, we talk about ETF inflows hitting all-time highs, tech concentration in the S&P 500, the risks of NVIDIA's weight in all these index funds, contrarian trades for your portfolio, and much more. I hope you enjoy this conversation. Okay, Todd, right now the tech sector is making up 36% of the S&P 500. We're probably getting more rate cuts. A lot of people are talking about bubbles, .com comparisons. Give us your lay of the land on markets right now.
So I'm using three keywords into 2026. Concentration, participation, and sensation, okay? There's a little bit to dive in there. You mentioned tech, 36% of the index. Top 10 weights are 40, 41% on any given day. That's the concentration aspect. That's not necessarily a bad thing. It's more of a, here's the condition, understand what's in your portfolio. If you have too much ownership of it, are you not diversified, right? Take stock of that. That's the concentration aspect. Participation, and this is where the technicals can really come into handy, is how many stocks are contributing to the move? Is it really just the top 10 weights? Or is the equal weight indices also participating? I think the equal weight indices are going to be really important for 2026. Not that they have to outperform, but as long as they're rising with the cap weight index, that tells you that participation is robust. That right now, they're a few percentage points off the high. We'll keep an eye on that. You do not want to see that diverge. And then sensation, I do think sentiment's getting pretty hot here. That's going to happen after the monster rally we've had since April. I just want to be mindful of equity flows are getting hotter. Investor surveys are very much more bullish. Put calls are very skewed to the call side. When sentiment gets a little bit too aggressive, that sets you up for a speed bump. Kind of like what we saw in April, even though that was more, you could say, tariff induced. But that's a setup for 2026. It's still a global bull market. There's no doubt about that. But I am just worried about people getting a little bit too enthusiastic right now in markets.
Do you think that enthusiasm warrants the discussions about .com levels of exuberance here?
Not to my knowledge, right? I think on one hand, yes, the S&P's 3-year percentage change, right? October 2022 to October 2025 is in the top decile historically. So we've run pretty hot. But then you look at stock companies like the Mag 7 and they are cash flow rich, right? They're producing profits. Of course, they have an outsized influence on the index. But back in the tech bubble, and it's not like I was a veteran back then, but you had all these companies that weren't making any money, right? It was fraud necessarily. So I'm not quite in the bubble territory yet. Is it odd to me that you had some random nuclear names and quantum names who may or may not have been producing revenue run up a couple 1,000%? Yeah, that's peculiar behavior, but that's more on the sentiment side to me than on a massive bubble, right? And I think that's where, even if we are in a bubble, taking diagnostic of the equal weight indices is going to come in really handy to understand if there's this massive divergence or not.
Can you explain that a bit more? Why watch the equal weight as opposed to the market cap?
So indices can lie, all right? If you have a name that's 8, 9, 10% of the index, and you have another name that's 8, 9, 10% of the index, right? These NVIDIA, Apple's, Microsoft, and especially in some of these sectors, like you have Amazon, Alphabet, Meta, they can skew a lot of what's going on. And so if we put everything on an equal weighted basis, right? Make everyone average, we're all the same stock, that gives you a better sense of what the typical company is doing rather than the behemoths. And the best analogy I can make is sports, right? Best team in baseball this year is the Dodgers, right? They won the World Series. Ohtani, amazing. The rest of the Dodgers, let's just say the rest of the Dodgers are fine. If Ohtani starts to slump, you need the bench to keep the rest of the team afloat. Right. So think about it. If the mega cap heavyweights start to slump, you need the rest of the index to keep everything afloat. If the bench deteriorates, then that creates a big problem.
So my understanding of, let's say, the last few months, we have seen this broadening out and this pretty healthy rotation. Mm-hmm. Is that something you think is let's say, a blip of exuberance and people are just buying everything? Or do you think it's genuine, let's say, a strengthening of the market?
Strengthening the market, right? And the best reflection of that was back in May when you had one of the better expansions in the new high data. So the number of stocks making a new high on every given day tells you how durable a bull market is. And as long as that's expanding, things are in good shape. Now, it has been a few months since that data has expanded, but the trend of the market is still very much higher. I think as long as you're seeing participation and good earnings across the board, which so far has been the case, you've got industrials working, big banks are working really well. It's hard to get in too much trouble when the banks act really well. Yes, of course, there are some issues in other parts of the financials, like the private asset managers. They've been a little bit lethargic. But I pair that off with credit spreads, which are still in their bottom decile historically. Right? Credit spreads are super tight, and you rarely get in a lot of trouble with tight credit spreads.
Okay. The signal that you're seeing in credit markets, how does that tie to what you're seeing in equity markets? Can you explain that a bit?
So it is rare that with tight credit, stocks get into trouble. I would get more worried if you started to see equities rise and different layers of the credit market, right? From triple C, triple B, B, when those spreads widen out, right? So widening credit, deteriorating credit backdrop with rising equities is a red flag. And it's possible. We've had clients ask us, is private credit skewing that? Maybe. It's not my wheelhouse necessarily. But as long as you don't have widening credit with rising equities, it's okay, right? And credit spreads can remain, one of the characteristics of a bull market is credit staying in this bottom decile, these super tight levels for quite some time.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. Speaking of the bull market, I know that you've done a lot of work on what year 3 of a bull market does, year 4, and so forth. Where are we in this cycle and what comes next?
So I have 2 angles to this, right? We have just entered year 4, right? October 22, 23, 24, 25. The year 3 turned out early to be matching up with what typically happens, which is a very choppy corrective market. That was October through April, honestly. And then the back half of that blew out any sort of historical comparisons. Year 4 is still pretty robust. The sample size shrinks because sometimes bull markets can end in year 3. Not very frequently, but it's happened. Year 4 is another robust year. I'm okay with that. Now, the other side of this, though, is in April 2025, during the tariff correction, 70-something odd percentage of stocks went down 20%. All right, and 20% is a arbitrary level, but that's what the industry goes by. There's no doubt about that. And so if you had 3/4 of stocks down in the S&P 500 down 20% from their 52-week high, that's a pretty good reset as fast as it happened. So is it year 1 now? You know what I mean? And I'm struggling with that. I don't know what the right answer is. By traditional metrics based on the S&P, it's year 4, but internally, that was a really good washout.
Wow, that's I haven't heard anyone talk about that before. If we're almost resetting the cycle based on politics or macro. So something that I wonder could also maybe influence this cycle is we're seeing this huge ETF demand across every sector. ETFs are getting tons and tons of inflows. I think in October, and you wrote this in a note, we saw $100 billion of inflows into ETFs for the 4th time ever. Does that skew the market in any way?
So ETFs do 2 things, 2 great things. One, for you and I, all the listeners, everyone out there, they are low-cost, long-term investing vehicles. They're great for that. Great for saving for retirement, for building generational wealth. On the other hand, what I like to use them for is a lens into the psychology of the market, right? A temperature barometer. Because I can measure every day where flows are going into what kinds of products, anywhere seeing elevated volume that maybe hasn't seen it. We had that with gold recently. And then the types of products that are coming out. Because ultimately, whenever there's a hot asset or a hot category, most issuers rush to launch something. It makes sense because you want to get all the assets, but at some point that trend can end. So back to what you said about $100 billion in October, that's part ETF adoption because it's becoming so important for portfolios, but it's also rare to see that level eclipsed, especially just in October. Usually it's in December at the end of the year. And so I'm fully aware that the pace of equity flows per day has picked up, and that's part of that sentiment that folks are getting a little bit more confident about the market rally. It's a good thing, but can set you up for a little speed bump when things get a little too exuberant.
So I think part of that data is also 2025 is on track to beat past years' records of ETF inflows. And So I spoke with Mike Green on the show, and he has a lot of concerns about passive investing and what that does to inflate asset prices over time. And if we're seeing all these inflows into ETFs, is there a connection between that?
Probably. I still think that, listen, the actively managed equity mutual fund industry is still bigger than ETFs, right? There's still more mutual funds in ETFs. There's still more assets than ETFs. So I do like to believe that active managers will be the ones who are setting where these prices are going. That being said, and similar to what Mike talks about, is if I own the S&P and I own the NASDAQ 100 or large cap growth, if I own maybe some theme ETFs that are related to tech, I have a lot of exposure to those top of the index names, the NVIDIA, Microsoft, Apple type names. Clearly has worked out, right? That's great for passive. But if I'm a portfolio manager, if I'm an advisor, I just want to know how many eggs I have in that basket. I think that's where the influx of ETF product that's out there, you have to be a little bit careful, and diversifying through other means makes a lot of sense.
Yeah, I think that does make sense. Something I know that you're also writing about a lot these days, the types of ETFs that are launching are specific to what's hot right now, as you just said. And we have a bunch of AI related ETFs, even though if you just buy the S&P, you have a ton of AI exposure.
Right.
And you also have a lot of leveraged ETFs. I think you said 1 in 4 in recent ETF launches uses leverage. What is happening here?
This place is booming. It's booming. If there's something that concerns, so man, this is a fun topic. So why do we launch levered ETFs? Because the passive space is so saturated. It's hard to compete with BlackRock, Vanguard, State Street, and Invesco. And levered ETFs they're frictionless. I don't have to open a margin account. I can just go on my phone and whatever brokerage I'm using and buy 2x, whatever it is. They're also lucrative for the issuers involved, right? You can charge higher fees. If you grow some assets there, that's great for the business just to make a living. But I'm a little bit deterred by where they're putting leverage on. Right. So levered single stocks, for example, came out 3 years ago, was due to some regulatory changes. You started with Apple, NVIDIA, Tesla, all the big blue chip type names. And then more recently, the market cap of the names they're putting leverage on has gone down below, say, $5 billion. So there are levered ETFs coming out where I have to look up the ticker. I'm like, I'd never even heard of that name before. Is it systemic? I don't think so, unless there's a lot of this going on off exchange that you and I maybe don't know about. But you inevitably read about some investor or trader who probably is involved with the leverage space, and maybe the stock misses expectations on earnings, goes down 40%. That means the 2X fund's going to blow up. You know what I mean? That's where I get a little bit worried.
Well, something I know also happened this year, we saw the relaunch of the meme ETF from Roundhill. And I think they're a great company, but I was surprised to see it come back given that it shut down previously when they launched it.
So Roundhill guys are great.
Yep.
Very friendly with them. Love what they do. Their Meme 1.0 launched during the top of the market in 21. I don't think it has to happen again, but I wouldn't rule it out. What they did though is they changed the methodology behind it, right? They changed it up. They said, let's find volatile stocks that are also popular on social media type boards. So I like that they changed the methodology and made it more meme-like. But of course, that's the type of names that are getting levered put on there, right? These quick, very volatile type of names that you've never heard of them, and all of a sudden they're up 1,000%. So I guess what a lot of investors might be doing is, all right, they have their S&P exposure. Now they're like, how do I, Eric Balchunas, one of the best in ETFs, calls it hot sauce. He coined that term, that they throw the hot sauce on their portfolio just to keep, I think, things busy.
It fits.
Yeah. So it's kind of fun to watch. I like making the visuals on it, but it's also another poster, along with the 100 billion flows we did last month, of confidence rising to a point of, hey, maybe just take your foot off the gas.
Do you think there's some type of, macro psychology playing into this? Because when I see a bunch of investors piling into more speculative names, leverage, things like that, maybe it's something to do with, okay, affordability is getting out of hand for everyday items, the economy for, let's say, the K-shaped economy. A lot of people can't afford housing or groceries, things like that. Do you think that's pushing people into more speculative investments?
Oh, perhaps. I guess that's one way to think about it. It's also ease of access, right? Via brokerages, apps on your phone, right? You think before you and I were born, to get options, margin, leverage, you had to be high net worth, and now anyone can do it on the street. Doesn't matter. So the ease of access, I think you also read headlines or you go on social media and it says, hey, I just made 10 grand in 3 hours. Like there's a jealousy aspect of that. It's a human nature to be jealous of, say, oh, my friends are making all this crazy money right now and I want to get a piece of that. So inevitably that kind of enforces that behavior too. And there's also what is the Federal Reserve. I'm not a big Fed watcher. I don't get into that, but over the last 15 years, they have come to the rescue when needed. So I think there's a mentality, and maybe that's changing, we'll see, that they will come support markets when a crisis brews, put liquidity into the system, and that's going to, again, jolt all these types of volatile names higher.
I mean, either the Fed or President Trump will tweet something, support the market.
The stock market has become so important to everyone's wealth, which is great. It's a great way to build long-term wealth. It's almost haphazard, though. Like every time there's a crisis, they will come in. And ideally, if there's liquidity, that's supportive for markets.
So I know something that you watch, and speaking of liquidity, money market fund yields are drifting below 4%.
Yeah.
And to me, when I see that stat, it's like, okay, we have $7 trillion of cash on the sidelines, so to speak. If those yields start to get less attractive, right, is that more bullish tailwinds here for the market?
So money markets are the most boring instrument on Wall Street, but they're one of the most fascinating psychological instruments as well, right? So from 2009 to 2022, you got 0% on the money market. It just sat there, not getting anything. If you needed cash to buy a house, that's where you put it. Fast forward, after the hiking cycle, you get up to 5%, a little bit more than that. And every conversation that we were having at Strategas was, this money market, it's great to have income. Now we're fast forwarding again. Now you're starting to cut rates, and those money market yields have dripped from 5 to 450. Now we're sub 4. So what I'm watching for, and there's $7 trillion in those funds, is when you get to about 3%, I think that's when a lot of folks realize, hey, after tax, I'm not really getting much anymore. And if you go back to the mid-90s, when the Fed cut from 10% to 3%, money market flows really stalled out for a while. And then they started to hike again in the late 90s. It resumed higher. Same thing in 2000, 2007. The only difference is those were massive bear markets. So that's when money, I think, started to come out. So the key point is, all right, 3% I think is probably the level when you see the assets really slow down and maybe start to see outflows. Now, where does it go? The problem with the cash on the sidelines idea is that money markets are completely different instruments than equity, right? There's totally different risk profiles. And if it's still a bull market in stocks, I would guess if you get 3% yields and lower, that some of it will go to different types of fixed income ETFs, right? Maybe I'll go to an active manager who can at least stretch out that yield to get 4% using high-grade corporates or something like that, or securitized stuff. If it's a bear market, then I would think, okay, maybe some of that actually does go to stocks because you want to take on some risk. But so the key going forward here is where is it actually going to go because of the risk profiles involved and demographics too.
Yeah, that's an interesting angle as well, the demographic change.
Yeah.
If we start getting, let's say, another couple rate cuts, historically when the Fed cuts rates without a recession, pretty good for stocks.
Yeah.
How does that impact the money on the sidelines? And then if there's no recession as well, where are markets going?
Should be higher, right? And as long as we have rates that are just kind of slow, stable, and lethargic, I'm talking like 5, 10, 20-year rates here, market loves that, right? It doesn't like shocks. The markets do not like shocks. And you've had the 10-year yield for the U.S. range bound for the last couple of years, and so stocks have done great. I think it's been interesting. You've had cuts over the last year, and long duration treasuries have not performed well. That's actually very different than what happens historically. Usually treasuries rise. So we'll see how that plays out. Where it does seem to be helping is small caps, right? For last couple of years, small caps have been terrible. Russell 2000 peaked November 2021, big decline, big trading range, frustrated everyone, including myself. People gave up on them. So now we have cuts. You have the Russell 2000 back to a new high, and it has a lot of unprofitable meme type stocks in there. But I wonder if you get more cuts and maybe some of that money market assets starts to chase small caps instead. People are going to re-engage that asset class because it's been out of the fold for so long. And it's another way to help diversify to some extent. All right. So I'm a little more bullish on small caps, I think, going forward.
I don't know of the investors I'm speaking with. I don't know that many people who are recommending small caps these days. Are you saying it's attractive?
I think it makes sense if you've had no small cap exposure or very limited to up the dosage, right? I wouldn't go overweight large caps. That's too hard. And historically, you only want to do that after a massive recession when everyone goes out and buys all the junk. But when you take into the concentration thing, right, 10 stocks, 40% of the S&P, if you're just looking for a different constituency set, small cap can help. The other item is, well, do you go Russell 2000, which is going to be all the small cap stocks out there, no gating, or the S&P 600, which is going to have a quality tilt because they want profitable companies in there. I think you do a mix here. It's not binary. And with the S&P 6, you'll get financials and tech and industrials. And then Russell 2, you'll get more biotech type companies, which, yeah, they can be a little bit lottery ticket depending on if their drug passes or fails. But I do want that here. So I like the idea of buying small caps, getting more involved, especially if you have not had any allocations to it.
I mean, it makes sense when you break it down like that, but I couldn't convince myself to buy into small caps right now.
This is a common phrase. I mean, sometimes we get looked at like we have 10 heads on.
Yeah.
When you mentioned small cap.
So something that Ryan Dietrich said on the show last week, he said, if everyone's thinking alike, someone's not thinking.
Yeah.
And the reason I bring that up is because, we're talking about ETF products in AI space are launching like crazy. The concentration in the market is all AI and tech. Everyone's obsessed with talking about AI and tech. Where do you see some of the, let's say, contrarian opportunities right now in the market?
For me, my favorite is healthcare. And it seemed, is it still contrarian? That's what I'm trying to figure out because it's definitely getting brought up more. But when I look at my data, right, I look at sector ETF flows every week, and these are not signals. Flows are not a signal, but they're a temperature barometer. And it's been icy cold for healthcare for the last year and a half, right? They've had the most outflows of any sector ETFs out there. And we aggregate all the different healthcare funds, all the different tech funds, et cetera. So that's interesting to me. And then healthcare's performance relative to the S&P is awful. Basement-like type levels, like just totally bombed out. So I think that's the contrarian case for healthcare that we can rebound. There was a point a couple of weeks ago where NVIDIA was almost larger than the entire healthcare sector in terms of weight in the S&P. NVIDIA's clearly the company of the year. But that seems like a buy signal for healthcare to me. And especially if you're looking to, again, water down the AI type stuff.
How much of the negative sentiment on healthcare you think just came from United Health?
Oh, that had to be a good chunk. I think a lot of it from conversations we had was also GLP-1. So Eli Lilly really took over the sector in the last couple of years. You take a GLP-1, you lose weight, you don't need an operation anymore. So maybe that hurts equipment names. You know what I mean? Like there's a whole chain of reaction from GLP-1s because I guess you're getting healthier. I don't know. I exercise a lot.
Yeah, no, that stuff is outside my lane.
So I think between that, the UNH stuff scared people, and then also the administration, frankly, right? You have a totally different health department in place now. And I think that scared a lot of investors about what they're going to do. So that's another interesting, and that's more anecdotal than data driven. So it was almost the perfect storm of all these things going on.
Yeah, it definitely has looked really bad in the sector. So speaking of the administration, something I've written about in my newsletter a lot is how every time Trump or the White House comes out and takes a stake or even talks about a sector or a business, a stock, the stock explodes higher. And it's happened every single time. But all these names and sectors they're taking positions in are energy, something to do with AI, and all of that sort of aligns with the concentration we're seeing in the broader market. Right. So my question for you then, is it even worth being contrarian if the government's betting on it, investors are betting on it, institutions are betting on AI?
man, it's a freight train I don't want to stand in front of. I'm just cognizant of how much you may own of it, right? And I don't know when the train stops. Maybe could be today, it could be 3 years from now, 30 years from now, who knows? But I look at it as, all right, I have 8% NVIDIA in my S&P, more in my large cap growth. How much more do I want? And then maybe it just makes sense to have some other stuff in the other corners of the portfolio. But they're clearly impacting certain things. I mean, you saw it with the rare earth names too, right? That was a frenzy recently as well. And it was interesting to see. So, with ETFs, you look at either precious metal ETFs or rare earth ETFs, you saw massive volume spikes recently because everyone needed a quick, efficient route to get exposure. And they went and bought all those rather than trying to look up the names and who may benefit. You just buy the ETF that has all of them in there. That's the great part about it.
And that's just, simplifying it all to just buy the ETF.
Exactly. This happens so frequently where just get the ETF to get the exposure and then figure out which name may actually benefit later.
Well, it's great for individuals, I would say, being able to do that. But then the risk, arguably, is that it inflates the entire market if you just go into these funds.
Yeah. And especially for smaller cap type names, right? When you start to see really big volume and inflows into esoteric corners, that can kind of create some liquidity problems for those stocks. Right? For NVIDIA, it's going to be fine because and Tesla, those are massively traded liquid stocks. But when you start talking about a Chinese lithium miner, you might have some problems there getting in and out.
Yes, absolutely. So we're seeing record inflows this year to ETFs. We're probably going to break last year's record.
Yeah.
Based on everything we've been discussing, the boom in ETFs, what's going on in 2026?
I think you'll see, more and more wild launches. So what's on the docket now, back to leverage, is there's an attempt to get 3x and 5x levered ETFs in play. Right, the government shut down as we're doing this, so TBD. Technically, you cannot have 3 and 5x, but there's some math wizardry that's going to go on behind the scenes in order to get them there. We'll see. So that's the one crazy part. I think you're going to see more usage. You're already seeing more usage of it, but you continue in 26 of the options market to create very different structured strategies, right? So the equity sleeves, again, are all taken care of. Everyone has their passive exposure. They're wondering, how do I protect myself? How do I hedge myself? Are there strategies that weren't available to me that were only available to high net worth individuals that are coming into ETFs? You have gone beyond the simplicity era of ETFs, and we're in the complexity era now. The strategies are getting much more complex. So I can buy an ETF that will say, I will protect you for 20% on the downside, buffered, structured outcome. But I'm going to cap you 10% on the upside. I think you're going to see more and more of this into next year using derivatives. And then the other angle is crypto, right? Throw in every kind of crypto strategy that is possible.
Do you think that's healthy for markets to be complicating the products that retail investors can buy?
Do I think it's healthy? I think it's a mix. I think it's great you and I can get all the access to these strategies that we probably wouldn't have been able to have access to, and the common person. But hey, you got to understand what's going on. You go to the grocery store, you have to read the ingredient label. You have to understand what this product's going to do. On the other side, I'm also a little concerned, what is the impact of some of these strategies on the options market, right? So I look at put call ratios every day just to measure market anxiety. But there are so many derivative products now using calls and covered calls. Is that suppressing what's going on in the options market? I'm not quite sure. I got to do more work on that. But that's another consideration. And not everyone's going to need some of these strategies. They're there, but they may not need leverage or buffered ETFs. It's going to be a very case-by-case scenario.
So I recently finished Andrew Ross Sorkin's new book, 1929.
Yeah.
Excellent book. But one of the potential factors that led to the great crash was a lot of Wall Street leaders and business leaders were pushing for the democratization of financial products and investment vehicles. And I've seen Andrew talk about this in interviews, how we're sort of seeing that sort of the echoes of that today.
Totally.
And it's like, if it's under the guise of democratization, that sounds great, but then there's risk involved if you're not studying what you're buying.
Totally. I agree with you. The word democratization kind of scares me right now. we don't need to democratize private markets, right? If you want private markets, figure out how to get private market or work your way to private market exposure. I don't need them in an ETF where there's going to be a liquidity mismatch and a private equity name in an ETF is not going to get marked for 10 months and have no idea what its value. Do you know what I mean?
Yep.
So, and the same thing with leverage. Again, if you want to use a levered product, know what it's supposed to do. Completely fine. I'm all for it. Like if you know how to go skiing black diamond, not that I ski on a black diamond, right? Know what you're doing, but to democratize something, I'm not sure I like that word now for ETFs. It just seems to be going overboard.
It's the way to hide risk.
Yeah, totally. That seems to be happening with some of these private stuff. You know, they want to democratize to retail, and I just don't know if retail needs that. Listen, they can put it in the product. Well, ultimately, the ultimate arbiter is going to be flows, right? If you get inflows, then it's clearly working. But if you don't, then something's off.
Yeah. So my last question for you, Todd, if you had to make the bear case going into the new year, where would you start?
So I would start with participation. All right. So we have these big cap names that are working fine. If I start to see certain leadership groups fall off, consumer discretionary, right? Been a little bit softer recently. Discretionary versus staples is a great market barometer, for risk appetite. If I start to see that falter, if I see big cap banks, JPMorgan, Wells Fargo, Citi, Bank of America start to correct and unable to rebound, that gets me more worried. And ultimately that leads into the participation factor where less stocks are in on the move. Right? I would start there. And then that would ultimately reflect back into the equal weight indices. When the equal weight index diverges from the cap weight, that's troublesome. I would start there. And then what does sentiment look like too? Right? If sentiment stays hot and you pair that off with deteriorating breadth, not a great combo. And then I wonder if it translates down to earnings at some point too. We'll see. I'm not quite there yet, but if I had to build the bear case, it's that.
I think that makes a lot of sense. Todd, I really appreciate your time. Thank you for joining us.
You too, Phil. Thanks very much.